All right, this is Ubaid on behalf of Electronics, and in this video, we'll be looking at tax incidence and elasticity. All right, so this is tax incidence, tax incidence, and elasticity. Now, when it comes to your tax incidence, this has to do with how taxes or tax burden, taxes are divided between suppliers and producers, between suppliers and you have consumers, rather, excuse me. So if you were to look this up on a graph, suppose this is your price over here, and this is your quantity, the demanded or supplied. And let's assume that this is your supply curve over here, and let's assume that this is your demand curve over here. And let's assume that this will be your equilibrium point, which means that this will be your equilibrium price. Okay, price at which the suppliers are able to supply what the consumers demand. Okay, and this will be your equilibrium quantity. All right, now, just because this is the equilibrium quantity and this is the equilibrium price doesn't necessarily mean that the suppliers will be able to sell at this point over here. Okay, the suppliers may sell less or may sell more. Now, if these suppliers, okay, end up selling less than the equilibrium quantity, so let's say the total quantity over here, assuming this is your equilibrium price. Okay, and let's just say that this is your demand, which is close to, okay, infinitely elastic. And let's assume that this is your supply, which is close to, okay, infinitely inelastic. This is infinitely elastic. All right, so this is infinitely elastic, and this is infinitely inelastic. All right, so if this is your, okay, say for example, this is your equilibrium point over here, QT over here, the producer is able to sell a certain number of units, which is less than the equilibrium quantity, QE. All right, so in that case, so suppose this is your supply over here, which is highly inelastic, and this is your demand. So basically what this means is that the suppliers are not able to change their prices as much as they would like. Okay, their retail prices, the price at which they sell. Okay, and this could be because they're not able to make adjustments right away. Let's say this is a real estate property and they can't sell the real estate property, let's just say at the market price. Okay, they can't sell the real estate property, um, okay, without paying the taxes. They can't make adjustments, okay, to the real estate property prices. They can't change the price, okay, despite the taxes. Okay, let's say if the excise tax goes up, okay, they can't bump the prices up. If the excise taxes go up, okay, because of the inelasticity, okay, they can't bump the prices up. Can't cannot bump the prices up. This is cannot bump the prices up. Okay, and because they can't bump the prices up, essentially what you're looking at, okay, over here, okay, this is your, okay, consumer price. So let's say PC, and this one over here, starting with 0, okay, total based on total quantity sold. So this is QT, total quantity sold. This is your Okay, producer price. All right, so this could be tax per unit times that by total quantity sold. Okay, hence this would be what the producers will end up paying in taxes, this area over here. And this is what the consumers end up paying in terms of taxes. Now notice that when the supply curve is inelastic, okay, the producers end up paying more in taxes. Okay, tax incidence has to do with how the taxes are distributed, how the tax burden is distributed amongst the suppliers and the consumers. So if the supply is inelastic, which means that the suppliers cannot change their prices, if they cannot bump their prices up when the taxes go up, they will end up paying most of the taxes and the consumers will end up paying less. Okay, and similarly, okay, likewise, if you look at another graph over here, and let's assume that in this graph, your supply curve is inelastic and your demand curve is elastic, which means that this is your equilibrium, this is your equilibrium quantity, this will be your equilibrium price, so PE. And let's assume that this is your QT over here, total quantity sold. And this area over here, this has to do with your producer price and what the producer will pay in taxes. So let's say this is what the taxes are like for the producer. All right, which means the producer ends up paying less in taxes. Okay, if the supply curve is elastic, which means if they can make changes to their prices based on taxes, if the tariffs go up, the suppliers can bump their prices up. If the tariffs go down, suppliers can bump their prices down. Then they do have the option, okay, to pay less in taxes. Okay, now this won't be the case if it's a hotel or a motel amongst many. For example, let's say this is a perfect competition where there are tons of hotels. Okay, the suppliers may not be able to reduce their prices unless all the hotels in the area reduce their prices or bump their prices up. Okay, which means if they don't bump their prices up, they end up paying most of the taxes. Okay, now if this is a restaurant, for example, this could be the same scenario where the restaurant cannot bump their prices up because there are tons of other restaurants that consumers can go to based on demand, based on the prices that these restaurants are offering. Okay, which means the producer ends up paying most of the taxes one more time. Okay, however, if this is a product such as cigarettes, for example, okay, or it could be another product where consumers housing, for example. Okay, so if you have housing or a product which consumers are addicted to, let's say cigarettes. So in that case, okay, what's going to end up happening is because the demand is inelastic, okay, this is close to your vertical line, which represents perfectly inelastic curve, okay, or perfectly inelastic demand. The demand is close to your vertical line, which means it's close to being inelastic, as a result of which the demand does not change despite the change in prices, despite the tax revenues collected by the government, despite the tax imposed on the retail price, okay, or despite the tax imposed to the supplier, in which case the supplier will bump the prices up and charge that tax to the consumer. All right, so despite that fact, okay, over here, okay, that the consumers are willing to pay for the product. Okay, it basically means that the consumers will end up paying more in taxes. So more of the tax burden is passed on to the consumer. So more taxes for consumer. All right, so this is basically how the taxes work. This is how tax incidence works. Okay, on behalf of electronics, this is Obey. Have yourself a great day.